as of this date only, and except as required by federal securities laws, the company does not undertake a duty to update any such information. In addition, during the course of the conference call, we will describe certain non-GAAP financial measures which should be considered in addition to and not in lieu of comparable GAAP financial measures. Please note that in our press release, Medical Properties Trust has reconciled all non-GAAP financial measures to the most directly comparable GAAP measures in accordance with Reg G requirements. You can also refer to our website at medicalpropertiestrust.com for the most directly comparable financial measures and related reconciliations. I will now turn the call over to our Chief Executive Officer, Ed Aldag.
Thank you, Charles, and thanks to all of you for joining us this morning on our third quarter 2024 earnings call. I'm pleased to be joined again today by Steve Hamner, Kevin Hanna, Rosa Hooper, and Jason Fry.
Good to see you guys.
Before you hear from the rest of the team, I'll spend a few minutes covering a few important recent strategic updates. The big news during the quarter was our global settlement with Steward and its creditors that enabled us to take back control of our real estate and sever our relationship with Steward. While there has been widespread media attention on Steward's bankruptcy process over the past few months, we believe these stories fail to note the significant steps that MPT has taken throughout the process to avoid hospital closures, protect jobs, and ensure continuity of patient care. When Steward was unable to complete transactions with buyers for its operations around the country, our team worked around the clock for weeks to identify a diverse set of qualified operators to take over facilities in 5 markets. We are confident these 5 operators are better positioned to serve their respective communities in Arizona, Florida, Louisiana, Ohio, and Texas. The 4 operators that assumed management of 15 facilities in September, HSA, Honor Health, Insight Health, and Quorum Health, have already done a tremendous job of stabilizing the hospitals in each market and laying the foundations to return them to profitability by providing high-quality patient care. They have dedicated significant time and energy to employee, physician, and community outreach, all of which have reportedly been well received. While it will take time for these facilities to return to pre-bankruptcy operational performance, we are very impressed with what we have seen so far. In most cases, October discharges are trending higher than the low point in September prior to these transitions. Earlier this week, we reached an agreement with College Health to lease the St. Luke's campus in Phoenix, Arizona. College Health has over 35 years of experience and specializes in inpatient behavioral health services. They expect to reopen the campus as a behavioral health hospital in the first quarter of 2025. With the successful re-tenanting of these 17 properties, which collectively carry a lease base of approximately $2.1 billion, we expect to gradually resume receipt of cash rents on this portfolio in the first quarter of 2025, ramping up to approximately $90 million in the aggregate annualized rent by the end of 2025, and fully stabilized aggregate annualized rent of approximately $160 million by the end of 2026. Assuming no further changes to our portfolio, when these 17 properties begin paying full rent, we expect MPT's total annualized cash rent to be in excess of $1 billion. We are also actively engaged in discussions regarding the 4 other properties with an aggregate lease base of approximately $170 million, as well as our development projects in Texarkana, Texas, and Norwood, Massachusetts. With respect to Norwood, we remain in discussions with the state regarding critical licensing decisions. Before moving on from Steward, it's worth zooming out for a moment to evaluate our real estate portfolio. Beginning in 2016, MPT spent roughly $5.3 billion on real estate that was leased or mortgaged to Steward. We recovered approximately 45% of that through cash proceeds from asset sales and other transactions involving this portfolio. As just discussed, we also continue to hold a real estate portfolio with a lease base of approximately $2.3 billion, excluding the development projects, more than 90% of which has already been re-tenanted. Over the years, we also collected approximately $1.9 billion in cash rent and mortgage interest. During the third quarter, we continued to advance our strategy of generating additional liquidity to accelerate debt paydown and enhance financial flexibility. We sold 18 freestanding emergency departments, as well as a general acute care hospital in Arizona and Colorado for approximately $246 million. In October, we sustained this momentum by closing the sale of 2 additional small freestanding EDs in Texas for approximately $5 million, as well as the sale of Watsonville Community Hospital in California for approximately $40 million. Watsonville is a great story of community perseverance and our business model working as intended. Watsonville was forced into bankruptcy primarily because it was unable to access COVID funding similar to most of the other hospitals in 2020. At the time, MPT was virtually the only party willing to step in and provide the funds necessary to ensure the hospital could remain open. Our close engagement with community leaders helped facilitate the formation of a local nonprofit to take over operations in 2022. And now for that same group to acquire the property outright. By exhibiting patience and focusing on doing the right thing for the community, we were ultimately able to fully recover our real estate investment. In closing, before I turn it over to Rosa, there is no doubt the healthcare sector is uniquely exposed to the impacts of global macroeconomic trends. At various intervals over the past few years, hospitals have been forced to navigate lagging reimbursement rates, declining patient volumes, heightened operating expenses, rising interest rates, revenue cycle management challenges, and cybersecurity incidents. While we are pleased that many of these trends appear to be reversing, it is important to remember that access to a broad array of potential capital solutions is critical to help ensure a flourishing healthcare sector over the long term. Simply put, sell-leaseback transactions are a superior financing source for many operators compared to any other sources available. Land and buildings are often an operator's single largest asset, and that must be funded with some form of capital. Sell-leasebacks provide a relatively inexpensive way for operators to access up to 100% of the value of their real estate to fund improvements that will more directly affect patient care. They enable operators to negotiate rents that typically represent only a small single-digit percentage of total sustainable reimbursement revenue and a plan for fixed annual amount over the long term without being subject to refinancing risk. For these reasons, we strongly believe MPT's business model is more important than ever. We continue to take meaningful action that better positions our business to create compelling shareholder value over the long term. And following our successful re-tenanting strategy, we look forward to demonstrating the strength and resilience of our business model. Rosa?
Thank you, Ed. As usual, I will take you through some of the highlights across our portfolio of critical hospital real estate. We are encouraged by the positive utilization and revenue trends we continue to see across our portfolio. In line with what's recently been reported by several large public operators, hospital fundamentals continue to strengthen. Admissions are growing, surgical volumes are increasing, and operators are starting to realize the benefits from cost efficiency programs they've been implementing over the past few years. Within our portfolio of hospitals, general acute care properties reported the largest increase in year-over-year revenues, followed by our behavioral health properties, which have delivered steady performance over the past several quarters. In the UK, utilization of private medical insurance and self-pay has hit a new all-time high as patient demand for quality and timely access to care continues. Circle Health is a clear beneficiary of this trend, reporting consistent growth in both private medical insurance and self-pay volumes. Circle's performance has also benefited from improved patient acuity mix as more complex cases are now being addressed in the private sector. In addition, The UK Health Secretary has called for the NHS to grow its partnership with the private sector to reduce their backlog. Priory, the largest independent mental health care provider in the UK, continued to produce positive cash flow from operations in 2023, and its cash flow generation has accelerated year-to-date in 2024. In fact, revenue and EBITDA are meaningfully outperforming prior year. Last quarter, we mentioned their focus on a comprehensive strategy for improving quality and optimizing occupancy mix. Continued focus on this strategy has increased acuity, driving reimbursement rates higher while promoting a more efficient utilization of external labor, resulting in bolstered financial performance, including improved coverages for the portfolio. Notably, the change in government in the UK has created some uncertainties around referrals into the behavioral health market, and Priory is anticipating lower occupancy levels. Their increased focus on higher acuity patients and collaborative work with commissioners should help to offset any potential disruption. Turning to Priory's parent company, Median, these assets have delivered strong year-to-date performance in 2024, driven by an improving reimbursement rate environment in Germany, as well as improving occupancy trends. Swiss Medical Network's solid top-line growth and ongoing cost optimization efforts have resulted in 10% year-over-year earnings growth for the first half of 2024. In September, Swiss Medical Network officially opened its Genolier Innovation Hub, which will also help to drive additional cash flows to MPT over time. They anticipate significant activity in this center, working toward the continuous improvement of healthcare for patients now, as well as for future generations. During the quarter, MPT and our JV partner increased the equity investment in Infracore by retiring approximately 50 million Swiss francs in maturing third-party debt. Turning to our U.S. portfolio, where my comments do not include the recently re-tenanted Steward properties, overall, general acute care revenue trends continue to benefit from increasing admissions, surgeries, and higher reimbursement rates. And in our behavioral portfolio, we continue to see steadily increasing volumes as well as reduced reliance on contract labor. Ernest Health's consolidated EBITDARM coverage remains stable at approximately 2 times, while Ernest's legacy IRFs continue to perform exceptionally well with coverages above 2.5 times. Their newer IRFs are continuing to ramp up with improved volumes quarter over quarter. In order to counteract the declines in LTAC reimbursement nationally, Ernest recently converted a portion of their Provo LTAC beds to an inpatient rehabilitation unit. Given the success of this unit, Ernest is actively exploring options to implement this model in other markets. LifePoint Health has produced strong top-line revenue growth and accelerating profitability, driven by the highest quarterly admissions seen in over 3 years. LifePoint's self-funded expansion of Conemaugh Memorial Medical Center in Johnstown, Pennsylvania, has driven significantly higher volumes while labor costs have continued to moderate. We believe this will continue to drive EBITDARM improvements looking ahead. At LifePoint Behavioral, consistent year-over-year admissions growth coupled with disciplined labor cost management led to another quarter of improved operating performance. And Scion Health's trailing 12-month EBITDARM coverage is up slightly year over year, as improved performance at its acute facilities is offsetting LTAC declines. Finally, Prospect's California facilities continue to report growth driven by admissions and surgeries, which have each increased 3% year over year. Despite improved coverage trends across the 6 California properties, Prospect's overall liquidity continues to be impacted by ongoing sales processes in various East Coast markets. While it's our understanding that Prospect continues to work with regulators and potential buyers in each of these markets, they have been unable to pay rent in a timely fashion over the past few months. Prospect expects liquidity to improve in the coming months as they are scheduled to receive approximately $100 million of Quality Assurance Fee Program, or QAF, payments during the first quarter of 2025. In closing, we are very encouraged by the volume, revenue, and cost trends being reported across care types and geographies. Today, we are more diversified than ever before with tenants like LifePoint, Ernest, HSA, and Surgery Partners in the U.S., and Circle, Priory, Median, and Swiss Medical Network internationally. The growth of these operators over the past 5 years has helped to largely offset the dilutive revenue impact of Steward's financial distress and asset sales. Moving forward, we are confident that our portfolio is well positioned to generate robust cash flows for MPT and our shareholders over both the near and long term. Kevin?
Thank you, Rosa. This morning, we reported GAAP net loss of $1.34 per share and normalized FFO of 16 cents per share for the third quarter of 2024. As disclosed in our Form 8-K filed on September 17th, our global settlement with Steward and its creditors resulted in multiple one-time accounting items that impacted our GAAP results and resulted in adjustments to normalized FFO. First, we impaired approximately $425 million of working capital loans previously made to Steward. Second, we recorded impairments of approximately $183 million, of which $180 million related to the real estate of the Space Coast facilities and certain excess properties, charges for property taxes and other obligations, net of recovery, and the donation of our former Steward-operated hospital in Hope, Arkansas, to the local community rounded out the balance. Lastly, the termination of our master lease agreement with Steward resulted in an accelerated amortization of about $115 million of lease and tangible assets during the quarter. Before wrapping up on Steward, as noted in our press release this morning, we have received substantially all of the $45 million of proceeds expected from the sale of the Space Coast hospitals in Orlando to Orlando Health. Normalized FFO was also adjusted during the quarter for the reduction in fair value or investment in PHP Holdings by approximately $130 million to roughly $200 million based on the most recent independent third-party appraisal. With that, I will hand the call over to Steve to discuss liquidity and capital allocation. Steve.
Thank you, Kevin. At the end of the third quarter, we had cash balances of approximately $275 million and revolver capacity of about $880 million. Year to date, we have executed more than $2.9 billion in profitable asset sales and other monetization transactions, including the approximately $350 million during the third quarter that we had previously described. These are primarily the sales for $246 million of 18 freestanding emergency rooms plus a general acute hospital that Ed mentioned, along with repayment by Prime of a $100 million mortgage loan. These transactions have effectively demonstrated, especially over the recent year since COVID, the strength of our business model in general and our real estate underwriting in particular. Not only have our real estate investments held their values in a volatile macroeconomic environment, but they have actually increased in value. This has provided us significant flexibility and optionality as we execute our delevering strategy. Since the beginning of 2023, we have repaid $2.2 billion in debt. We have aggregate 2025 maturities of approximately $1.2 billion, which we believe we are well positioned to address with our current liquidity and other options, including additional possible monetization transactions. For example, since the end of the quarter, we have settled certain insurance litigation that will result in incremental cash to us during the fourth quarter. We closed the Space Coast sale, resulting in about $45 million to us. The Watsonville and small FSED sales mentioned earlier resulted in another $45 million. And we have signed non-binding LOIs and offer sheets for profitable sales that would generate additional cash proceeds. The aggregate of these transactions approximates another $400 million. With respect to these non-binding LOIs and offer sheets, I will point out that there are buyer diligence rights and other conditions, and there is no certainty that these proposed transactions will actually be completed. We now believe that our cost of debt has likely peaked and is in fact coming down, albeit at different paces depending on the geography. At the same time, MPT continues to resolve difficult tenant situations and simplify its business strategies for the future, which we expect will make us more attractive to capital markets in the future. As a reminder, the normalized FFO of 16 cents we reported for the quarter does not recognize income from tenants we have moved to cash-based accounting. That includes investments related to about $1.6 billion of real estate formerly leased to Steward, now leased to new operators and accounted for under the cash basis, and an additional $400 million of real estate previously leased to Steward is accounted for under the GAAP basis straight line method. We have plans to resolve these in the coming few quarters, even further simplifying our business or returning them to collection status. When considering these portfolio simplification efforts, our success in re-tenanting more than $2 billion of real estate formerly leased to Steward, as well as anticipated interest rate and capital market improvements, we expect an expanded set of levers to be able to address debt maturing in 2026 and beyond. As such, we are not limited only to continue reducing the size of our portfolio in order to meet our capital allocation objectives, especially given that we believe that even with the level of normalized FFO that we reported this morning, we are confident there is significant unrecognized value in MPT's current share price. With that, I'll conclude and we'll be happy to take questions, and I'll turn the call back to the operator.
We will now begin the question and answer session. To ask a question, you may press star then one on your telephone keypad. If you're using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then two. We ask that you please limit yourself to one question and one follow-up. At this time, we'll pause momentarily to assemble our roster. Our first question will come from Michael Carroll with RBC Capital Markets. You may now go ahead.
Yep, thanks. Can you talk about why the working capital loans to, I guess, the former, on the operators taking over the former Steward assets increased to $90 million, and kind of highlight the timing of the expected repayments? I mean, how long does it take for these operators to get the necessary ABL that could pay back those working capital loans?
So, Mike, it's a simple question, simple answer on the $90 million, and that was additional primary professional fee costs not related to MPT or the new operators for the transitions. On the ABLs, some of them already have replacement ABLs that they're in works with. Others believe that they'll have them completed either by the end of this quarter or the early part of 2025. These are short-term loans, and we expect them to be all repaid in 2025.
Okay, great. And then can you provide an update on the PHP sale? I mean, Ed, I believe last call you kind of highlighted that the final bids for this asset was due in August. I guess, did that sale process, is that starting to get completed? And then maybe kind of when you're answering that, can you highlight why the write-down in the PHP, why did that specifically occur again this quarter?
So Mike, the write-down is based on the most recent what we believe reliable information that's available to us, and we can't comment further on the status of what are continued confidential negotiations amongst the buyers and seller, which is PHP.
Okay, great, thank you.
Uh-huh.
Our next question will come from Omotayo Okusanya with Deutsche Bank. You may now go ahead.
Hi, yes. Good morning, everyone. Could you please, for the assets that have not, the Steward assets that have not yet been transitioned, that you guys are now operating. Could you just give us a sense of the earnings impact of those assets in third quarter and how we should kind of think about that going forward until you can also transition those assets?
Well, Tayo, these aren't operational facilities. These include the Youngstown, Ohio facility, which has been closed for years, the San Antonio facility, which was closed, I believe, last year. It also includes Sharon, Pennsylvania, which is operational, but it's not operational by us. It's still being operated by Stewart. And then it also includes a facility in Miami, was when Stewart still owned it. It had been rehabbed and was getting ready to open, and it's still closed at this particular time. So it shouldn't have any additional impact negative on MPT.
Okay, that's helpful. All right, that's about it for me. Thank you.
Our next question will come from Nikita Valley with JP Morgan. You may now go ahead.
Good morning, guys. A couple of modeling questions. Where do you think you could issue new secured and unsecured debt today? At what cost?
Yeah, so we're not contemplating that right now. As I mentioned a few minutes ago, we're hopeful, I think with good reason, that the yields on the outstanding notes are coming in. I think that's a result of two things. One, improving macroeconomic conditions in capital markets, and then obviously as we resolve Stewart, and our hope and anticipation is that Prospect follows shortly on that with resolution, that the market spreads will also come in. But again, right now we're not even out testing that market.
Mm-hmm. What about the early thoughts on 25 term loan maturity? You think you'll extend it or pay it off with sales?
We think we have options on that. That's a good question. As we laid out, our liquidity allows us a lot of optionality, whether that gets extended, partially extended, paid. We have liquidity now, and with anticipated transactions that I walked through a few minutes ago, we think that gives us the optionality that I mentioned.
Okay.
This concludes our question and answer session. I would like to turn the conference back over to Ed Aldag for any closing remarks.
Thank you, Anthony, and thank you all for listening in today. And as always, if you have any questions later on, please give Drew or Tim a call.
The conference is now concluded. Thank you for attending today's presentation. You may now disconnect.
So my Discord is popping off right now about the analysts not seeming to give a flying you know what, because that's like I mean, I felt like the first analyst at least asked some good questions, but the stuff about Prospect, right? Yeah, like the analysts are barely paying attention, so how are they coming up with the estimates? But of course, the Prospect stuff, they're not gonna tell you anything until they actually have a final number and are, set to close it, basically. So it's like you could predict that there wasn't really going to be a real answer. I mean, I'm glad they asked the question, but you already kind of know what they're going to say on that one. Norwood was in the press release. Norwood is the flood water or whatever, that dispute with the insurance company that went to court or whatever, and that's a big one because My understanding is there was up to $200 million up for grabs there, so that's pretty big deal. Prospect seems like it's just almost as bad a mess as Steward. What about the payment of operator license fees? Yeah, I don't know if I heard anything about that. Expenses of 360. So, I think a lot of it was one-time, what they're calling one-time things, but it's just funny. Like the last handful of quarters, every single quarter has had a bunch of one-time things. But you got to imagine that if Steward's not going to be part of the next quarter, that probably there will be fewer one-time things. Hopefully, they said they're hopeful. Isn't that what you want to hear from management, that they're hoping? Yeah, I'm surprised that none of the analysts asked about the dividend. That's a little bit weird. The analysts did not care, it seemed like. I would assume that unless we hear otherwise, that we should just assume the dividend is just as is for now. Yeah, I don't know where this idea of we're going to get all this money for opcos or whatever. In fact, I don't even think we even heard anything regarding, so what about the opco? Like the analysts didn't ask it, et cetera, et cetera. I think that was just a drummed up thing that somebody on Yahoo tried to infer into existence, to be honest. If you were on my Discord, you would have seen me say that I don't have high expectations for anything involving the opcos. Can't afford a higher dividend. I mean, maybe not. Well, technically, their normalized FFO should theoretically be the upper end of what they could afford. And yeah. But honestly, I'd rather them not try to push it on the dividend. Don't want any danger on the liquidity. Is it a light at the end of the tunnel or an oncoming train? That is the question, isn't it? Maybe. So I guess this isn't really something that they would go over on the earnings, but there were those two investors that each have over 5% now. They were willing to put a couple $100 million apiece into shares. So, and I'm not sure if it's because they know something that we don't, or if it's just that we've all been fooled somehow. So the net loss that they took is all paper losses. It's not like actual cash that they paid out. So when you look at what the net loss was reported on GAAP, that will be how much book value will end up being reduced. Does that help? So what I think is that the results were pretty bloody and bad, as expected, right? Expected it to be bad this time, and I expect fourth quarter, if anything, to be sort of my hopes. My optimistic hope is that the fourth quarter is kind of neutral. Just no more movement in the wrong direction. And then Q1 2025 hopefully will be positive. A lot of the things that they've alluded to that might be positive were supposed to occur in the early part of 2025. However, it always seems like a moving goalpost, doesn't it? So, yeah. And I think this will put the book value somewhere around $9, give or take. So it's pretty rough. It's been definitely a hacksaw has been taken to this company. Yeah, that's what they said, that they expect the net rent revenue to be. Which, yeah, that would be better than what it's been. You could say they've been unburdened by what has been. It's a little hard to it's a little hard to be too happy right now, but I'm always I mean, granted, I can't even imagine if I had paid like $20 or whatever per share for this, and if I still like, I would just be like I would need to be under observation if I had paid that kind of money for this. What would you guys rate the earnings call out of 10? We're getting some answers on Discord. 2 out of 10 from Beater Stocks, 1 out of 10 from a guy that's going by the name MPW, 3 out of 10 from Stabulo, but he gave the analysts a 0 out of 10 for their questions. I mean, don't hold it on my account. Yeah, that's true. They didn't get too much. All right, so we got a 3.5 out of 10 from Honest Virtue, a 2 out of 10 from Prashul. Yeah, I know it was kind of lackluster. 2.5 from Hein. Yeah, so definitely weird also that nobody even asked about the dividend. Maybe the missing fourth analyst was meant to ask about that. I don't know. So, anybody got any opinions about the two whale buyers that got in for over 5%? Oh, okay, that's pretty brutal. The shorts will say a 10 out of 10. Yeah. Yeah. I mean, if they can refinance their debt at a level that's not too crazy, yeah, no, I don't think it's going bankrupt. They're doomed like us. Nah, I mean, honestly, I think what we really need in terms of prospect is we need Yale New Haven to go through, and we just need PHP to finally sell. Though on Discord, we're basically thinking PHP is worth like $50 at this point. They'll take it into you'll see them try to sell it on Pawn Stars on the History Channel, and Rick will be like, $50, it's what I could do. Physician networks just take up a lot of real estate in my pawn shop. Oh boy. They're trying to do math on Discord right now. So, anyways, guys, unless anybody has any last questions, comments, concerns, I'm probably gonna just call it a day. Call it a day on this, and be happy that all my other stocks are pumping. But if you do actually want to help out the channel, since I've got you all live at the moment, I do have a Discord linked in the description. Also, I am I'm somewhat sponsored by Moomoo, and if you sign up through my link, it helps. They've got low margin interest rates, access to options, 8.1% bonus APY on uninvested cash, and they don't charge any monthly fees or anything for signing up. So unlike Robinhood Gold, where you have to pay like $5 a month, they don't do that. And it helps the channel a lot if people sign up and deposit. So just a thing I like to throw out there. So there might be somebody out there. I mean, I feel like anybody that bought at that level is probably dumped out of frustration by now. My average is like 6 something, and I get frustrated. So I can't even imagine. However, I think, and I don't know if, I don't know if we might be hearing about rates if there's going to be a cut or something soon. A rate cut would probably be helpful. I mean, it might be a little lower if you factor in dividends and such, but I mean, I either let the dividends pile up, put them into something, or wait for what I think are buying opportunities. But honestly, I haven't really bought MPW much in a while. Peachy, are we doomed? Peachy, no, I don't think we're doomed. I don't think it's amazing, and I'm not like super. I wasn't expecting to be super thrilled today, but I am a little disappointed with like the analyst presence on the call. 3 of them came in, and I think like 2 of the 3 barely asked anything. So I don't know. Dividend was not discussed at all, and the whole the whole idea of what they might have gotten for opcos wasn't really that I just don't think that that's even a thing. I think that was invented on the Yahoo boards. So, and that's what I've been saying all along, is that I think that was invented on the Yahoo boards. If you look at other videos I've made recently on this, I haven't said they're going to get a ton of money for opcos. I might have mentioned that the Yahoo board thinks that, but it's not really something I've been trying to hang my hat on. Yeah, me too. Surprised. Mostly what you'd expect. Yeah. I would say of what we did get, of what little information we did, it was mostly within parameters that I would expect. You know, you get the preamble, then you get the Rosa like EBITDARM thing where it's like 90% good news until the end, where they mention how bad prospect is, and yeah. And then the analyst questions, where you would hope somebody would ask something smart and it doesn't happen. Just more proof that JP Morgan and Deutsche Bank and stuff, when they set price targets on something, that's why I don't care that much about analyst price targets. The shocking part was the enthusiasm of the analysts. Yeah, that was pretty bad. This was almost as weird. I mean, not quite as weird, but almost as weird as like the 8-minute conference call from Paramount a couple quarters ago. So my main curiosity right now is about Mr. Yet and Mr. He. I don't think you get 2 whales buying 5% plus in something unless there's something cooking. But the problem is that we don't know what that is, and they are fallible and could be wrong just like anybody else. So it's hard to hang too much on it. Though one question I always got asked was, if this is so, yeah, I wish I'd pulled the trigger on that back when it was like $80, like I because I called it as a value play, but I just didn't put any money in it. Whoops. But with these super investors, or they're not really super investors necessarily, but they're definitely whales. It answered a question that I get a lot, which is, if it's so great, how come no big investors have gotten involved if it's undervalued? And they have now. So it might just be some reinforcement that there's upside, or that there's more likely to be upside. And I'm going to guess short interest is going to be pretty high. So I'm interested in seeing what short interest looks like after this, next time we get that information available after this conference call, because the conference call didn't inspire that much confidence, because when asked straight up about their strategy for tackling debt maturities, they talked about being hopeful. It's like hope isn't a strategy. That's the problem. I don't like words like hope in a conference call. So, according to what I've heard, Quorum is kind of a scraping the bottom of the barrel type operator, and so that could be interesting. But there's from what I understand, there was 3 operators. There was, I think, Honor Health, which I believe was good. Quorum, which was kind of, and then there was maybe one other one that I haven't really heard much about. So we'll see. Yeah. AHS, American Horror Story. So, once again, I want to appreciate everybody that came in and watched the live stream of the conference call. I saved all of my commentary for the end, because that's been what you guys have expressed as a preference. We do our own Q&A because the analysts didn't provide a very good one. Anybody want to ask anything else or mention anything else that maybe didn't get covered yet? I'm starting to have some Wi-Fi issues, by the way. So if it suddenly goes out, I'll have to call it. You feel that fourth quarter is going to be a good one, and that's the hidden message. I appreciate your positivity. And Brain Dead, which that's just a name, not a fact, says we'll have to see 2025. Till then, it's a hold for him. Okay. Well, Peachy, I'm glad we actually got to have you along for this little discussion. So, all right, Wally Sparks. By the way, meet Wally Sparks. Best Rodney Dangerfield movie ever. You will never change my mind on that. I can't hear you. This tank top's too loud. So dividends did not get mentioned and did not get asked about, as far as I know, and they were not mentioned in the press release. So I think we should assume business as usual, 8 cents. That's the safest assumption. I would guess just no change to the dividend at this point. Now, we might get a Q4 surprise where they're comfortable, making some predictions about that. Other health REITs all project 2025 as a better year. Sounds like. Okay, that's good. Yeah, I mean, it's been an exercise in patience for me, for sure. Like, if you think about it, I got my first 100 shares near the end of 2022 after a very big, well, at the time looked like a very big slide in share price. And it just goes to show you that just because something's gone down a lot doesn't mean it can't go down even further. It's definitely changed my perception of how I evaluate value and risk and everything like that. So, since we're nearing the 1 hour mark, I just want to remind everybody Discord's linked in the description, and we discuss MPW there quite a lot around earnings time and in between, anytime there's any news pertaining to them or any of their tenants or any big insider buys or any whales buying, anything involving the stock, we're all over it. The people in my Discord are diligent, and they sometimes get information well before I would have found it on my own. Another thing, again, if you want to help out the channel, I would encourage you to subscribe if you're not already, although I think most of you watching probably are. Like for the algorithm, and consider checking out Moomoo through my link in the description and help enrich me to offset some of my losses in MPW. I would appreciate it. Continue to sell puts for a year. Effective cost basis is close to like 3. That's pretty damn good. Yeah, I'm hoping I can free up some cash soon to get back to put selling. I like options premium. I like options premium a lot. It makes me very happy. So, here's the thing. Every time I'm in the green on this stock, I think to myself, do I want to sell some calls? Do I want to maybe sell some of the position? But then I think, well, how bad would it feel if this time is the time that shorts start closing? Because short interest is still quite high. I don't know exactly at this moment how high it is, but I would be shocked if short interest was lower after this earnings call. So this could be a honey pot from the perspective of you've got a short squeeze potential on the table, and some other things going on. Though some of the stuff with prospect is a little bit worrying. Seems like there's we're never running out of things to kind of worry about. Yeah, Peachy, I considered doing that. I really kind of wish I had at this point, because then I'd have more cash to play with right now. But I know, like, the one time I decide that I'm going to pull the trigger on something, that's when it's going to go, even higher yet. You know what I mean? That's just always how it goes with me. My timing is just next level. I can never quite time things perfectly. I'm not Stabulo. All right, guys. Since we're basically at the 1 hour mark, I want to wish you all a farewell and hope you have a good day. Again, links to anything relevant in the description below. Appreciate you all joining me. Take it easy, and until next time.